Good afternoon. I'm David Luberoff. I'm the Deputy Director of the Joint Center for Housing Studies, and it's my pleasure to welcome you to today's talk on whether mortgage forbearance can help stabilize the economy. Before I introduce our speaker, I want to tell you about a few upcoming events. Next Friday, October 27th, Hojung Lee, a former Joint Center postdoctoral fellow who's now an assistant professor at Seoul National University, will be presenting new research he's done with two of our Joint Center colleagues, examining whether millennials are leading a back to the city movement or moving to the suburbs. This will be online only, like today. A week after that, on Friday, November 3rd, we'll have the second in the two events we're doing this semester, with co-sponsors from around the university focused on issues on homelessness. This will be a hybrid event featuring University of Washington professor Greg Colburn, the author of Homelessness is a Housing Problem, and Lyndia Downey, head of the Pine Street Inn, which is the largest homeless service provider in New England. And 2 weeks after that, we'll have another hybrid event marking the release of a new book of essays on the state of housing design. You can find more information about these and other events on our website. Now on to today's presentation. We'll be hearing from Sean Lee, a PhD candidate in economics, who's one of the Joint Center's Meyer doctoral fellows. He'll be presenting new research on the macroeconomic impacts of the mortgage forbearance provisions that were part of the 2020 CARES Act. Sean's going to talk for about 40 to 45 minutes, and then we'll have about 15 to 20 minutes of questions. We'll end right around 2 p.m. We'll post a video of this event early next week, and sometime in the coming weeks or perhaps month, we will publish a working paper by Sean as well. Sean, I'm really looking forward to this presentation. It's all yours.
Thank you, David, for the introduction, and thanks for inviting me to the seminar. I'll share my screen first. Great. So hi, everyone. My name is Sean. I'm a PhD student in Harvard Economics. And today I'll talk about mortgage forbearance, which is based on my paper titled Household Liquidity and Macroeconomic Stabilization, which is joint work with Omeed, who's joining us as a panel today. And I wrote this paper while I was a visiting fellow at the Federal Reserve Bank of Boston. So the usual disclaimer applies that this is our own views and not the Fed's. Great. So the COVID-19 crisis, as you may all know, was a time of unconventional fiscal policy. In response to the economic fallout, the Congress passed a stimulus bill known as the CARES Act that was truly massive in size and scope. And a major part of the CARES Act was devoted to relieving households' financial distress. And in particular, it included a forbearance program in the mortgage market, which allows for a suspension of mortgage payments for a fixed duration of time. The CARES Act forbearance was eligible for all federally backed mortgages. So these include those that are securitized by GSEs or guaranteed by government agencies, which collectively account for 78–80% of the mortgage market. And here are some key institutional details. So as opposed to normal times, there were no late fees or penalties associated with forbearance, and missed payments were not reported to the credit bureau, and borrowers could be in forbearance for a maximal duration of 18 months. No documentation was required, and you simply have to attest to COVID-related financial hardship to enter. And when borrowers sort of exit forbearance, they're generally given an option to defer their missed payments to the end of their mortgage maturity as an interest-free second lien loan. So we can essentially think of this as a free loan from the government that lets you postpone your mortgage payments for some period of time. One other thing that I might add is that you cannot refinance your loan while you're in forbearance. So if you're not experiencing financial hardships and you expect to refinance your loans going forward, you have no incentive to go into forbearance, even if you're eligible. So overall, the concept of forbearance is not new, and it existed before the pandemic as well. But what's interesting here is that the CARES Act made forbearance almost universally available and practically free for a big proportion of the market. And just to give you a sense of how the program rolled out, among the GSE mortgages, the forbearance rate quickly rose to 4% right after the program started, peaked at 5% around May and June, and has slowly declined afterwards. The black bars are showing forbearance entries. There is a big spike in the first couple of months, again followed by a slowly declining stream of entries thereafter. For exits shown by the gray bar, it's most common to exit after 3 to 6 months, but again, there's a slowly declining stream of exits after that as well. And the forbearance rate is even higher for other segments of the market, for example, among Ginnie Mae mortgages, which are generally considered to be riskier. But the overall trend is basically similar to what we're seeing on the graph for the GSE mortgages. And I just want to note that in this paper, we'll be focusing on the GSE mortgages primarily due to the data constraint, and I'll talk more about it in a few slides. In terms of the dollar amounts, suspended monthly payments on forborne mortgages were $900 on average, which is somewhat smaller than the stimulus check amounts. But remember that it's $900 on a monthly basis, so the total amount of liquidity provided over the duration of forbearance is quite sizable. The impressive size and speed of the program must have provided homeowners with significant relief, but how effective the program was in sort of stabilizing the economy is yet to be understood. In particular, the question that we have in mind are first, what is the effect of increased household liquidity on economic stabilization during the recession, which is an important consideration for designing fiscal policy directly targeting household balance sheets. And second, what would be the government spending multiplier on this type of liquidity injection happening through household debt relief? Or in other words, how much value are we creating per a dollar of government spending on this program? And in this paper, we're going to try to answer these questions by studying the macro stabilization effects of forbearance on local labor markets. And essentially, we'll be comparing the labor market recovery of different US regions that varied in the amount of liquidity provided through mortgage forbearance. And this is a map that shows the regional variation in forbearance rates across different zip code areas as of June 2020. And here we can see right away that there is a wide variation in forbearance rates across different areas, ranging from almost close to 0% to more than 7.5%. And another thing to note is that there is a significant variation even within the same state. For example, if you look at Texas, we again see a wide range of outcomes from close to 0 to more than 7.5%, as evidenced by different shades of reds. And the reason why I'm pointing this out is that this will be very important later on in our empirical analysis, because we'll essentially be comparing different zip code areas within each state that receive different amounts of forbearance. But as good as it sounds, there is also a critical identification challenge, which is that forbearance outcome is endogenous to local economic conditions. What do I mean by that? More distressed areas will also require more forbearance. So we cannot simply compare the labor market outcomes of these regions, but rather we need to find some other source of exogenous variation that is not affected by local conditions. And here's a quick preview of our findings. First, we find that there is a substantial heterogeneity in forbearance outcomes depending on who your mortgage servicer is. And mortgage servicers are financial intermediaries in the mortgage market who collect monthly payments from the borrowers and deliver them to MBS investors in the secondary market. For example, going from the servicer in the 25th percentile to the 75th percentile, we find that the forbearance probability increases by an amount equivalent to 24% of the mean forbearance rate, which is pretty substantial. And second, we're then going to exploit this cross-servicer difference and the regional variation in the market share of these servicers to construct an instrument for the local forbearance rate. So basically, we can think of this as the average servicer effect of a given region. And we're going to show that this instrument has a significant explanatory power for the forbearance outcome of a given region. And in our main analysis, we're going to use this instrument to estimate the effect of mortgage forbearance on economic stabilization and recovery from the recession. And we find that 1 percentage point increase in regional forbearance rate leads to roughly 30 basis point higher monthly employment growth in non-tradable industries. And we take this as an evidence that mortgage forbearance enhances household liquidity and sort of expedites the recovery from the recession by boosting local demand. And to microfound this labor market effect, in number 4, we analyze our empirical result through the lens of a stylized macro model. And we find that our labor market estimate can be microfounded with an annual MPX, or marginal propensity to spend, equal to 0.67. In other words, if people have spent 2/3 of every dollar that they got from mortgage forbearance within a year, we would see this effect in the labor market, which is very reasonable. And we compare this model implied consumption response to some of the existing estimates for direct fiscal transfers like tax rebates. And we find that they are pretty similar to each other, which adds some extra credibility to our findings. And in the last part of the talk, I'll show you a very simple back of the envelope calculation of the fiscal spending multiplier effect. And we're going to show that the multiplier is potentially sizable, with our preferred estimate being around 2. And this implies that for every dollar of government spending that goes into providing mortgage forbearance or mortgage forbearance program, the labor market grows by $2.25. But of course, this is subject to the caveat of repayment structure for bond loans and the monetary policy stance, which governs the prevailing interest rate. This paper is related to a few different literatures, but most notably in the second bullet point, we connect to the literature about the role of financial intermediaries in the mortgage market. There is a number of works in the past that shows that mortgage servicers widely varied in how they implemented federal level fiscal policies following the Great Recession. And we find a very consistent pattern in the context of the COVID recession that, forbearance outcomes substantially varied across different mortgage servicers for otherwise identical borrowers. But we're going to take this one step further and kind of exploit this feature for identification. And with all that said, here's our game plan for today. First, I'm going to discuss intermediation frictions in mortgage forbearance. And I'm going to describe how we exploit the regional variation in this friction to construct an instrument. And then I'll talk about our research design, present our main empirical results, followed by a discussion of some back-of-the-envelope calculation that we did to interpret our findings. And then I'll conclude by opening up to discussions. As I discussed in the introduction, the CARES Act made forbearance almost universally eligible and practically free for all federally backed borrowers. But the enrollment was not automatic, and people had to kind of contact their mortgage servicers and request forbearance, either for the initial entry or for any extensions thereafter. And due to this feature, a significant fraction of the delinquent borrowers did not enter forbearance. In the GSE market, for example, this fraction is around 15 to 20%. And it's kind of hard to understand why borrowers make such mistakes. But we find that a big part of this phenomenon can be attributed to supply-side constraints coming from mortgage servicers. So although the program was at the federal level, mortgage servicers who collect payments were ultimately responsible for processing forbearance requests. And it turns out that different servicers kind of widely varied in their organizational practices in how they handle the program. And for example, this ranges from the ease of contact, accuracy of information, and also the application procedure itself. And just to give you a somewhat more concrete sense of what we're talking about, I'm quoting a couple of anecdotes from the CFPB complaint database. The person in the first bullet point is complaining that he wants to get forbearance, but he cannot get in touch with the servicer in the first place, even after waiting for 36 hours on the phone. And anecdotes of this kind also include, servicers wrongly requiring documentation or providing misguided information about what happens at the exits, which can kind of scare away the borrowers. On the other hand, some other servicers made it super easy for borrowers to enroll by setting up a clickable button on their website. And in some cases, like the person in the second bullet point is saying, they enroll people in the program kind of semi-automatically when the person only called them to ask questions about the program. So taking these anecdotes as a motivation, we next formally estimate the servicer's forbearance propensities. And we primarily rely on the GSE loan level data set, which is a monthly panel of the universe of fixed rate mortgages that are securitized by Fannie and Freddie. And in addition to a wide range of loan characteristics and payment history, it provides information about forbearance status, identity of large servicers with bigger than 1% market share, and finally, the first 3 digits of the property's zip code. And using this data set, we run the following predictive regression. On the left-hand side, we have an indicator variable equal to 1 if a loan is in forbearance at each month. And we regress this indicator on loan characteristics XIT that includes interest rate, principal balance, and some borrower information at the time of origination, such as credit score, LTV and DTI ratio, and an indicator variable for the first-time home buyer. We also include alpha ZT, which is zip3 by month fixed effects. And this is really meant to absorb any time-varying regional conditions, for example, COVID exposures that may also impact demand for forbearance. And most critically, we include alpha S, which is servicer effect. And we're going to interpret this term as servicer-specific forbearance propensity for observably similar borrowers. And we also tried a few different versions of the outcome, for example, forbearance status conditional on being delinquent, but the results are all pretty similar. So what does it look like? We're plotting the distribution of servicer fixed effects in 2 ways. One as a histogram on the left, and second as a forest plot for the top and bottom servicers on the right. And in both figures, we can see that there's a substantial dispersion in servicer effects. Going from the top to the bottom servicers, there is approximately 6 percentage point probability difference in forbearance propensity. And this corresponds to the following, where when we move a borrower from the 25th to the 75th percentile of the weighted servicer distribution, that borrower's forbearance propensity increases by an amount equivalent to 24% of the mean forbearance rate, which is quite substantial. And in the next step, we're going to exploit this cross-servicer difference to construct an instrument for the regional forbearance rate. And we do this in the following way. This is the same loan level regression that I showed a couple slides back, but for the purpose of constructing the instrument, we do this thing called leave-on-out estimation at state level. So for each zip3 that is part of a given state, we estimate the servicer effect using only the data that's outside of that state. And this is to ensure that there is no mechanical correlation arising from region-specific servicers that only operate in limited areas that may also correlate with local economic conditions. So we can think of this as we're only using large servicers that operate in multiple regions. So they're not catering their forbearance provision to region-specific distress or region-specific local economic conditions. And then in the final step, we aggregate the servicer effects by the pre-pandemic market share of different servicers to get our instrument. And this is essentially just the weighted average of servicer effects, where the weights are their regional market shares in a given zip code area. And finally, we verify that our instrument actually captures variation in mortgage forbearance. And here I'm plotting the forbearance rates for ZIP3 areas that are at the top and bottom quartiles of our instrument distribution. And we can see that at peak, around May and June of 2020, there is roughly a 2 percentage point difference in regional forbearance rates, which is quite sizable. And of course, this is just a suggestive evidence because this could be totally due to a difference in regional characteristics, for example. But when we run the regression, where we control for potential confounders like regional characteristics, composition of the population, state fixed effects, COVID rates, and whatnot, we find that the differences are still not fully explained and remain sizable and statistically significant. Although the magnitude is somewhat smaller, of course, and it shrinks to around half. So we'll be exploiting this servicer-induced variation in the supply of forbearance to identify its impact on local labor market recovery from the recession. Great. So with all that said, here's our regression specification. This looks complicated, but bear with me for a couple of minutes. In the first equation, we basically correlate the mean change in outcome E for employment from T0 to big T on the mean forbearance rate during the same time period. And in the second equation, we use our shift share instrument variable, SS, to instrument for the forbearance rate on the left-hand side. So essentially, this is a cross-sectional regression of ZIP3 areas where we correlate the change in outcome and forbearance rates during a fixed window. Because this is a regional regression, and we know the regions are different in so many dimensions that could confound the effects, we control for pre-COVID regional characteristics, big X, that include average loan characteristics, demographics, and economic characteristics. And we also control for time-varying characteristics, big P, that includes, for example, predicted employment growth based on the local industry composition. And lastly, we control for the state fixed effects, which is to account for any statewide differences, for example, different laws about unemployment insurance, different lockdown policies, COVID regulations, and all kinds of stuff that happen at the state level. So at the end of the day, we'll be comparing different zip code areas within each state that receive different amount of liquidity from mortgage forbearance that cannot be explained by forbearance demand coming from regional characteristics. And one complication that arises due to COVID is that, as we have all experienced, there was a nationwide lockdown that roughly started in March of 2020. And because our outcome variable is employment in non-tradable industries that are most heavily hit by the lockdown, where no action is likely, we start the regression window from statewide reopening dates that vary from April to July of 2020. And we take these dates from records from Opportunity Insights at Harvard University. And we look at a fixed length of time period of 18 months after the reopening. And lastly, our identifying assumption relies on the conditional exogeneity of the shifters in our instrument. Or in other words, we assume that high and low exposure areas to the servicer effects, those regions are not differentially affected by other aggregate variables that might be correlated with the servicer effect. And we're going to show some evidence for this in a few slides and interpret what this really means. And before we talk about the main results, our primary outcome variable is non-tradable employment from the Bureau of Labor Statistics QCW data. And we adopt a standard definition of non-tradable sectors, which includes the retail trade and accommodation and food services. And it's kind of important to understand why we want to look at non-tradable industries. And the reason is pretty simple. To the extent that non-tradable industries provide region-specific services, you can think about the demand for these industries are based only on local demand. For concrete examples, we can think about restaurants, barbershops, hotels, a bunch of little shops in our neighborhood and stuff like that. And this is in contrast to tradable industries, for which the demand can come from not just the region in which the goods are produced, but also from other parts of the country that buy that good. So if we want to understand the effect of giving more forbearance to a given area, we need to look at the region's non-tradable industries, because that's where the local demand will cleanly show up. And with all that said, here's our regression results. To clarify on the units first, we're expressing forbearance rates and employment growth in percentage terms, and our shift share instrument in terms of standard deviation. So in column one standard deviation increase in our shift share instrument leads to 0.39 percentage point increase in the regional forbearance rate. And when we add ZIP3 controls in column 2, the magnitude of the coefficient decreases to around half, but remains statistically significant. So what this really tells us is that even when we include an extensive set of controls that proxy for forbearance demand, the cross-servicer differences that capture the variation in the supply of forbearance still remain to be sizable. And in column 4, conditional on ZIP3 controls, one standard deviation increase in our instrument leads to 0.06 percentage point increase in monthly non-tradable employment growth. And finally, in column 6, we find that 1 percentage point increase in forbearance rate leads to 0.29 percentage point increase in monthly employment growth, which is our headline finding. And just as a point of reference, note that the mean and the standard deviation of the outcome variable during our time period are 1.1% and 0.5% respectively in the bottom 2 rows. Next, we also ran a placebo regression for the pre-pandemic period by looking at the change in outcome exactly 1 year before our main window, which roughly goes from April 2019 to March of 2020. And this is really just to verify that our identification strategy is working. So in the first 2 columns, we find no effect in the first stage on local forbearance rate as expected, because mortgage forbearance is not common and only used for a small number of distressed borrowers in normal times. And in the next 2 columns, we again find no reduced form effect on the labor market growth, which kind of confirms the absence of pre-trend and supports our identifying assumption. We also expand our focus just a little bit and also look at tradable industries and total employment. And tradable industries include stuff like manufacturing, agriculture, forestry, fishing and hunting, mining, quarry, oil and gas extraction, whatever that can be transported across different regions. And in contrast to non-tradable employment in the first 2 columns, we do not find a statistically significant effect for tradable employment in columns 3 and 4. And this aligns very well with the theory, economic theory, where the demand for tradable sectors does not come from local economy. So it's unlikely that local forbearance outcome is going to impact the demand for tradable industry, which is exactly what we see here. In column 5 and 6, the effect on total employment is positive, and much of these are likely driven by non-tradable industries. And lastly, I'll show some robustness to covariates and test out the sensitivity of our estimate. And here again, we're focusing on our main 2SLS or IV estimate. At the top, in row 1, we just have our baseline estimate for comparison. And from rows 2 to 6, we control for the specified variable in addition to the baseline ZIP3 controls in 1. For example, in row 2, we control for the COVID rate and the death rate reported by Opportunity Insights. And in row 3, we control for the share of mortgages that are, in row 3, we control for population density to account for the difference between urban and rural areas. And in row 4, we control for the share of mortgages that are refinanced. And in row 5, we control for the PPP amount. And I think this is especially interesting because, and also reassuring, because just like mortgage forbearance, the PPP or the Paycheck Protection Program of the CARES Act it was intermediated by banks in the financial sector. So our instrument that relies on the distribution of mortgage servicers or financial intermediaries could be predictive of the PPP disbursement as well in theory. But fortunately, we find that this is not the case, as evidenced by the robustness of our estimate to including this as a control. And in row 6, we also control for local bankruptcy filing rates. And finally, in the last row, we include everything and still find that our estimate is quite robust. So all these robustness checks are adding more credibility to our finding that our instrument that are based on intermediation frictions arising from mortgage servicers is actually working. Great. In the last few minutes, I'll show some back of the envelope calculation that we did and talk about how to interpret our results and kind of relate it to how we should design these policies going forward. We ask two key questions to facilitate the interpretation of our findings. First, what is the mechanism behind our empirical results? We already kind of alluded to it along the way, but in this paper, we mainly focused on the consumption effect of mortgage forbearance. And the mechanism that we have in mind are as follows, where forbearance provides households with some liquidity relief, which boosts local demand. And this in turn leads to faster recovery of employment in the local labor market to satisfy that improved demand. And given this mechanism, a related question is, what then is the level of spending that justifies our empirical estimate on employment growth in the labor market? Or in other words, how much of the liquidity provided by mortgage forbearance should the people have spent to achieve the level of labor market growth that we see in our empirical analysis? And is it similar to existing estimates for consumption responses out of other forms of fiscal transfers? And the second question is that, is mortgage forbearance an effective fiscal stabilization tool? How much are the benefits worth compared to the cost? Or just to be a little more technical, is the cross-sectional multiplier of forbearance comparable to that of other policies? And in order to sort of answer these questions in a systematic way, we're going to build a macro model kind of tailored to our specific setting. I'm not going to go into details of the model, but I'll just point out two key points. First, in our model, we implement a stylized version of the mortgage forbearance policy where mortgage borrowers are basically allowed to skip their payment at period 0 in exchange for increasing their mortgage debt in the future. And the key idea here is that forbearance is an intertemporal liquidity transfer that does not affect overall debt obligations. And the second key feature of the model is that we're modeling geographical heterogeneity in intermediation frictions, where specifically we assume that forbearance is implemented by a local servicer subject to some operational frictions. And as a result, not everyone in a given area gets forbearance in the end. So these two features really essentially capture the key idea behind our empirical analysis and our identification strategy. And under this setup, the key result of our model is given by the following equation, where the increase in non-tradable wage bill of a given area is the amount of liquidity provided by forbearance times some constant C, where the C term can be decomposed into the following equation in the second line. We don't have to understand what all these terms are, but the key idea here is that we can compute every term in this page, either from our empirical estimate or from the literature, so that we can back out the term in the red, which is household level MPX, or marginal propensity to spend, which is the term that we're interested in. And our calculation suggests that the household level MPX is 0.67. And this implies that 67% of liquidity provided by mortgage forbearance is spent within a year. And reassuringly, this is pretty consistent with existing estimates from the literature. For example, the estimates based on tax rebates are in the range of 50 to 90%. And people receiving Alaska Permanent Fund spend 73%. And a meta-analysis in 2020 reports the mean and the median both as 70%, which is pretty close to our estimate. So overall, this makes our finding a little bit more interpretable and also adds some credibility to our labor market results. And lastly, I'll briefly talk about our back-of-the-envelope calculation of a cross-sectional fiscal spending multiplier. And the basic idea is to think about what is the effect of a dollar spent on providing this mortgage forbearance program on the labor market. And we do this by calculating the dollar value of employment effect in the numerator and dividing it by the total cost of the program in the denominator. And the numerator can be computed directly from our empirical estimate, as we saw a couple of slides back. So we can just focus on computing the denominator. For the denominator, the total cost of the program depends on two assumptions. First, the repayment structure of forborne loans matter. In other words, what people do when they exit forbearance is a very important input. And recall that borrowers are generally given an option to defer their payments to the end of their mortgage maturity as an interest-free second lien loan. And in the data, we actually find that payment deferral was the largest exit category. So for simplicity, we're going to assume that all mortgage borrowers take up this option. And the second assumption is that we assume that the interest on deferred payments are financed with a bond of maturity equal to effective remaining years on all forborne mortgages. And we assume that the interest rate on this bond is equal to the 30-year Treasury rate when the CARES Act started, which is 1.46%. And under these assumptions, our estimate of multiplier effect is 2.25. And this implies that for every dollar of government spending that goes into providing mortgage forbearance, the labor market experiences a benefit of $2.25, which is quite sizable. And I want to highlight that the key reason why mortgage forbearance is highly cost-effective is because it's an intertemporal liquidity transfer and not a direct wealth transfer. In other words, borrowers who get forbearance, they need to ultimately repay their deferred payments they postpone it to the end of their mortgage maturity, but when the time comes, they ultimately have to pay that. And the government, in the meantime, only has to pay for the interest payments that are waived for that deferred amount. And one interesting point here is that the cost of forbearance is sensitive to our assumptions about the interest rate. In particular, the forbearance program becomes incredibly cheap and effective when it is debt financed at a low interest rate. So this implies that there could be a room for interaction with expansionary monetary policies in times of crises. To conclude, we presented evidence of intermediation frictions in household debt relief during the pandemic, and we used this feature to estimate the macro stabilization effect on local labor market recovery. Our estimate suggests that intertemporal liquidity transfer through debt forbearance can be a really cost-effective fiscal stabilization tool. And just to share some of my thoughts on sort of open questions, in this paper, we mainly focused on the consumption effect of forbearance, but there are other potential general equilibrium effects of forbearance in the housing market. For example, there exists some research by people at the Fed about how mortgage forbearance had a small but positive impact on house prices. But more generally, I think it'd be interesting to study other effects like preventing foreclosures, mortgage originations and refinancings, and also to spill over to MBS prices in the secondary market. So this concludes what I prepare for today. Thank you, and I'd be happy to answer any questions.
Thank you, Sean. Really, really interesting work. And many of you have been asking questions. Many of those have been answered by Sean's co-author, but I'm going to duck in here for a second. Sean, I think you started to touch on this, and I may have just missed part of your answer, which is how do we think about the cost of the forbearance program, right? That you provide a zero interest loan, so the future value of that deferred money, and in a sense, who bore that cost?
Right. So the way I think about this is, at least in the GSE market, I heard based on my conversation with some of the practitioners and people at the Fed, the rule of the game was mortgage servicers had to pay out of their own pocket the first 3 months of liquidity, and after the 3 months, they were reimbursed by the government. So the way I think about this is, it's the liquidity is ultimately coming out of the government's pocket. And the way they finance it is usually with tax expenses or through deficit financing. And in this paper, we took a particular approach, which is based on deficit financing, but then I don't have a strong stance on how exactly it is financed. But then I kind of I demonstrated the cost benefit analysis if we take an approach of debt financing through issuing a long-term bond, which is treasury or something along that line.
So do we have a sense of what the magnitude of those transfers were that you described? From well, I guess it's pretty much the value of the what you had.
So you are right that it's not totally an intertemporal liquidity transfer, at least the way the CARES Act was designed, because when they exit, the government allowed people to postpone their missed payments as a second lien interest-free loan. So all the interest payments that they owe to the government, you can think of this as sort of some form of direct wealth transfer. But the magnitude of that is very, very small compared to the benefit, which is shown by my cost benefit analysis.
In the paper, you have some, I thought, pretty interesting data on the mix of what happened to the people who were in forbearance. And
right.
I want
I can
exact figures, although you probably have them. Yep, there we go.
So this is what happened at the exit. This
Right.
is only for the GSE market.
Mhm.
And when GSE mortgage borrowers exit forbearance, these are kind of showing what they took up on. And one interesting thing that I'll flag is that approximately 1/3 of the borrowers had no missed payments. And there just is a very interesting pattern where 1/3 of the borrowers who entered forbearance, they continued to make payments. So it's not like they were kind of taking up on this option, or rather they are sort of using it as an insurance in case they lose a job, or when their paycheck kind of falls short in 1 week or something like that. But at the end of the day, 1/3 of the people continue making payments, and when they exit, those people do not owe anything, which is shown by the black bar. And when we exclude these people, the remaining that's shown by the red bars kind of shows that payment deferral was the largest category. There was some fraction who got loan modification, and some exited by selling their home, and some just like paid in lump sum. But it seems to me that payment deferral was by far the largest and the most popular option that people took up on. And of course, this is, I'm only using the GSE market, so I cannot speak to what happened in the, for example, Ginnie Mae segment of the market, but I suspect the pattern will be broadly comparable.
And just sticking on households in the program, do you have any more information on any of the characteristics of who took up forbearance? So whether it was household income, whether it was loan to value ratios. I don't know if you can speak to that, or if the data just doesn't allow you to really answer that question.
So I can look into that. I don't have any specific numbers on top of my head, but the general trend is that people who took out forbearance were generally riskier and lower income, lower socioeconomic status borrowers. So we can see that from, they had, on average, they had the size of their mortgage was a little smaller. Their monthly payments were also smaller, coming from the fact that they probably have a smaller house, or they live in an area where that's relatively not as expensive. So there is certainly some selection going on, but then remember that roughly 5% of the entire market entered forbearance at one point. So this is not this is a very widespread phenomenon that's not really specific to one, socioeconomic group.
But if I would it be fair to say that or how much of a stretch would you say that data might suggest that those households might have been most likely to be affected by, particularly at the beginning of the pandemic, right? We know that
That's right. Yeah. So forbearance, again, was not automatic. So you had to request forbearance to get one. So to the extent that people who have forbearance are those who requested it in the first place, those are likely to be the people who experience some financial hardships during COVID.
I was thinking as I was listening to you that certainly in some of the debates more recently about federal spending and federal policy, there's been a lot of skepticism about some of the CARES Act and successive acts. And I mean, I hear you saying, I think correctly, this actually proved to be a pretty effective program. What's the lesson here for policymakers the next time there's some sharp macroeconomic, hit in the economy, whether it's a pandemic, any number of many bad things that could happen? What do you take away as, if you were asked in the elevator by the ubiquitous senator, what should we do? What would be the three things you would highlight?
The way I think about this is that, in preventing any default or foreclosures or whatnot during difficult times, ensuring liquidity to households is by far the most important thing. And there are many different ways of achieving that from the perspective of a government. One could be, stimulus checks that went out to a bunch of different people during COVID. And the other could be, something like mortgage forbearance that I'm talking about today. Well, then it's kind of worth highlighting what's the difference between the two. At the end of the day, it's pretty similar that people are getting these extra liquidity. But for the stimulus checks, we're just giving money to the people. So from the perspective of the government, the cost is literally the dollar amount, as opposed to if you give mortgage forbearance to mortgage borrowers, then those who are in need will only enter forbearance. And then the cost for providing that liquidity is much, much, much smaller than giving stimulus checks, because again, this is an intertemporal liquidity transfer. They will pay that amount back in the end, but just not now. And in the meantime, the government can only finance the interest expenses. And when you compare, even with the same effect, if you compare the costs associated with it, then this mortgage debt forbearance program is much, much, much cheaper. Well, but as good as it sounds, one caveat is that, these sort of debt forbearance only happens or only available to people who actually have mortgages or have some sort of debt. So there is some sort of limit in what targeting that we can achieve through these programs. So stimulus checks do have their own role, and these debt forbearance programs have their own role as well. So it's not like black and white, but like a right mix of different programs, with the ultimate goal of ensuring household liquidity as much as possible in a well-targeted way, would be my take.
That's very helpful. Thank you. I'm struck, for your research purposes, it's clearly very helpful that there was this wide variation in the behavior of the service providers. But I'm wondering, from a policy perspective, if that in and of itself is something that we ought to be concerned about. And I don't, am I right in do you share that view? And given that, do you have any thoughts on what we might do again the next time something bad happens and requires a policy like this?
That's a very interesting question. So, as I alluded to in the literature review slide at the beginning of my talk, um, you know, the role of financial intermediaries or servicers or lenders in the mortgage market is very, very important. And we saw the same pattern. We've been seeing the same pattern over and over again. So during the Great Recession, for example, we saw a very, very similar pattern where different mortgage servicers widely varied in how they implemented uh, uh, some of the programs that were implemented after the Great Recession. And during the COVID recession, we're seeing this thing again. I don't want to be I don't want to sound too prescriptive or anything, but then it kind of, as you alluded to, like it worked out really well for me, um, because it allowed me to identify this effect. I don't have a great proposal about, I mean, there's obviously some welfare loss by having these frictions in intermediating these different programs. I don't think I have a clear solution, but I am aware of this other paper, closely related paper by people at the Fed, that also looks at, you know, the intermediation frictions in mortgage forbearance during COVID. And their focus is a little bit different from mine, in a sense that I sort of used this mortgage forbearance program to look at macroeconomic stabilization. What they did is they focused more on why there was a friction in the first place. And this is a paper by Kim et al., which just got published in Journal of Financial Economics 2023. So for those who are interested, I highly recommend reading that paper. And then I also know that at the beginning of COVID, there were some discussion about whether we should make this an automatic thing, or if we make this in a demand sort of, you know, on need basis without requiring documentation. Like too many people will enroll in the program just to take advantage of it. But ex post, it's sort of we're in a consensus, I think, that, you know, that's not what happened. So people, it was pretty clear that only the people in need entered forbearance, and there were not that many evidence about you know, people kind of trying to take advantage of this program. So that's one, you know, reassuring evidence that this program kind of worked.
The discussion about mortgages, I find myself periodically returning to the question about renters, right? So that, and particularly given that some of the data indicating that it was less affluent homeowners. I guess there are two thoughts. One is, has anybody, to your knowledge, done any kind of a similar analysis of what happened to people who received some of the rent relief checks? Or if you could do that, what do you think you would find a somewhat similar pattern? And given that the focus of this is the folks who need it the most, how would you think about what an optimal design for programs? I think we've got some good idea about homeowners. Are there lessons here for thinking about how to design rental relief programs?
That's a very interesting question. I am aware that there were, you know, eviction moratoria for renters, both for households and for small businesses. I am not fully aware of if there's any systematic research that looked at that. So I'm kind of limited in my knowledge to speak to that realm. But one thing that so my colleague at Harvard Economics PhD program, she actually looks at commercial eviction moratoria. So the idea there is, all these small businesses kind of renting the property. During COVID, they obviously had a hard time making rental payments. So what the government did is they banned the eviction of those renters, even if they're not making payments during COVID. And the one shocking difference in institutional details is that for mortgage forbearance, people were allowed to postpone their payments to the end of the mortgage maturity when they exit. But then for small businesses or commercial eviction moratoria, the lump sum payments were expected when the program ended. So, if businesses sort of expect that, even if they can endure for 6 more months, at the end of 6 months, they can not make that payment anyways, they ended up just defaulting earlier. So I thought that was very interesting. And then, obviously institutional details are very important in this context. So maybe my guess is that we can port some of these ideas from mortgage market to better designing, the exit provisions or categories for other rental policies as well. But obviously, it's just my guess. I'm very limited in my knowledge to speak to that topic.
So, my internet has been glitching a little bit, so I'm not catching the complete answers, but I caught enough. Let me ask you one last question, which was, we go into research projects with some expectations, and I'm wondering what most surprised you in this research, if anything, or did you find exactly what you thought you were going to find?
I was just really surprised to find that, there's a lot of differences, cross-servicer differences in forbearance outcomes. So, I mean, I'm not a homeowner, so I don't have a mortgage. I don't have any experiences in, getting mortgage myself or anything. But then my guess was that, people shop around, but they don't really, they most certainly do not think about, oh, when COVID happens, would I be able to get forbearance from this mortgage servicer? Probably not. But then when things actually happen, these frictions are causing a lot of troubles to some people. And then we're seeing this over and over again. So it happened during the Great Recession. It's happening now again. And I'm just kind of surprised to see that there wasn't any sort of policy action that's geared towards sort of alleviating these frictions in the intermediating market. Yeah, so that I was most surprised by that aspect.
It is fascinating, and as you say, it's a recurring problem. Well, we've come to the end of our time. I find this research really fascinating. The Meyer Fellowship, is a way that the Joint Center tries to provide support for young scholars doing what we think is important research. I was pleased to note when I was preparing for this that your advisor, David Leibson, who knows much more about this subject than I do, described your work as path-breaking, and said it reveals I actually think that what you've shown here is really significant, and said that it reveals some really important linkages between household behavior and overall fiscal policy. Who am I to argue with David Leibson? Really to say the Joint Center is thrilled to have been able to provide support for this work, thrilled to have hosted this seminar, and we look forward to publishing your working paper and following what I think is going to be a tremendous, productive, and impactful body of work that you're going to do in the years to come. So thank you for this presentation, and thank you for this work.
Yeah, thank you, David, for having me in the seminar.
And thank to all of you for joining us. Join us again, as I said, next week for a presentation by Hojang Lee on whether millennials are moving to the city or the suburbs. Have a great afternoon, everyone.